You are watching Daily Market Pulse. Today is Saturday, April 11th, 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. Markets are trapped between US-Iran military escalation and a structural AI boom, while the Fed prepares what analysts call the biggest policy error in history. Here is the framework for today's briefing. US-Iran military escalation, 24-hour diplomatic deadline as Trump prepares military assets. Fed policy error. Warning, why analysts call this the biggest mistake in Fed history. AI hardware versus macro weakness. Structural boom creating sector-specific breakouts. Precious metals rotation. Capital flowing from crypto to gold miners. DeFi yield revolution. 11.5% returns solving wealth inequality instantly. Let's start with the most immediate risk facing markets right now. Vice President Vance is leading high-stakes diplomatic negotiations with Iran in Islamabad with a 24-hour deadline. President Trump has publicly stated the U.S. is reloading ships with advanced weaponry, signaling potential military escalation if negotiations fail. This represents the most immediate geopolitical risk to markets. The conflict centers on Iran's nuclear enrichment rights, and failure could trigger oil supply shocks through the Strait of Hormuz, which has already been closed for 45 days. Flight to safety flows are already pressuring risk assets. Defense stocks see rotation as the conflict may serve dual purposes, resolving tensions and forcing industry restocking of aging weaponry. What to watch next? The diplomatic deadline and any military deployment announcements. Oil prices and Strait of Hormuz status remain critical for global liquidity impacts. Now let's turn to what could be an even bigger risk: Fed policy. Former Fed insider Danielle DeMartino Booth warns the Federal Reserve is committing a historic policy error by maintaining overly tight monetary policy. The labor market shows 14 consecutive months of negative payroll revisions, while GDP growth rapidly slows. Recent inflation spikes are primarily from temporary oil supply shocks, not persistent demand. The Fed's hesitation to cut rates stems from political posturing around Jerome Powell's tenure rather than economic fundamentals, risking a self-inflicted recession. Precious metals are gaining as the primary hedge against potential credit events. Growth assets face medium-term bearish pressure from the higher-for-longer stance, while private credit faces liquidity crisis risks. What to watch next? The Federal Reserve rate decision and Powell's rhetoric this week. Any signs of policy pivot or continued hawkish stance will drive major positioning shifts, but there's a major opportunity emerging from this volatility. While broad markets face headwinds, the AI sector is experiencing a genuine productivity boom with severe supply-demand mismatches for GPUs like H100 and B200 chips. Market analysis shows medium-term rotation toward hardware AI technology over software and consumer sectors. This isn't just hype, it's structural demand driven by productivity gains and supply constraints. National security imperatives guarantee continued funding for AI infrastructure providers, creating a divergence from broader macro weakness. Hardware AI stocks are breaking out despite macro headwinds. There's clear rotation from broad market exposure to selective positioning in AI compute infrastructure and related supply chains. What to watch next? AI compute hardware earnings and supply chain developments. Any resolution of GPU shortages or expansion of production capacity will impact sector dynamics. This macro uncertainty is driving a significant shift in precious metals. David Scarrica identifies a major rotation of speculative capital from stagnant crypto assets into undervalued junior gold and silver miners. Central banks are actively accumulating gold and silver while shifting away from U.S. treasuries. Global debt levels at historic highs necessitate a parabolic move in gold prices to facilitate eventual debasement and debt resolution. The current market correction has washed out speculative excess, setting up for a cleaner, more sustained precious metals rally. Large-cap miners are trading at historically low valuations relative to gold prices. Junior miners with near-term production potential offer the highest leverage to anticipated parabolic gold price surges extending through 2030. What to watch next? Gold price momentum and central bank accumulation data. Any acceleration in currency debasement fears will drive additional rotation into precious metals equities. Speaking of structural shifts, there's a revolution happening in yield generation. A significant wealth gap exists in traditional banking yields, where the bottom 50% of individuals earn near zero returns compared to the top 10% earning 2 to 3%. New decentralized finance solutions are offering approximately 11.5% returns regardless of account size. Approximately $20 trillion is held in bank accounts split between individuals and corporations. Fixing yield inequality through decentralized mechanisms can be solved instantly, compared to the 10 to 20-year timeline required to address broader income inequality. This suggests potential capital inflow from traditional finance seeking higher yields, which could support altcoin liquidity and stablecoin demand as retail capital migrates to yield-generating protocols. What to watch next? DeFi protocol adoption rates and total value locked metrics. Any regulatory clarity or institutional adoption will accelerate the migration from traditional savings. So what's the summary and conclusion for today? We're seeing markets caught in a fundamental tension. Geopolitical escalation and Fed policy errors create serious headwinds for risk assets. But the AI productivity boom and yield inequality solutions offer genuine structural opportunities. The key is selective positioning, avoiding broad market exposure while capitalizing on specific themes like AI hardware, DeFi protocols, and precious metals rotation. Thank you for watching today's briefing. We'll be back tomorrow with your next market update.